This is Trepp with a special guest podcast, Global Investing in Commercial Real Estate. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus, Senior Managing Director, and joining us today is David Bitner, Global Head of Capital Markets Insights at Cushman Wakefield. Welcome, David.
Thank you for having me. I'm really excited to be here with you all today.
David, if you wouldn't mind, share your background and your role at Cushman Wakefield for our listeners.
So I started my career as an investment banker with Merrill Lynch in New York. After that, I joined McKenna Capital Management, which is a 20 billion AUM endowment style manager located in Menlo Park, California. There, I work closely with the global investment strategist focusing on global cross-asset strategy. While there, I also completed my MBA at Berkeley and then left to join Cushman Wakefield, where I was originally America's head of capital markets research, and since last year now, global head of capital markets insights. I sit within our global think tank, which has specialists on office, residential, alternatives, data centers, logistics, new commerce, demographics. We have, an excellent futurist. We have representatives from our company around the globe, and we collaborate together to drive thought leadership for the business and hopefully the industry.
And a recent report that you published, the Signal Report Global Guide to CRE Investing, was interesting to us and was what spurred us to invite you to talk to us today. It said that global investment in commercial real estate is poised for a bounce back in the second half of this year. Walk us through some of the considerations that you guys considered.
So our goal with the Signal Report was to provide a comprehensive outlook for the market over the next year. So if you're going to talk about the investment market, the foundations of that are in the pandemic, the economy, the occupier universe, and then the specific features of the capital market. So that's the availability of debt and equity capital, the risk tolerance of different kinds of investor groups, their willingness to trade, their certainty in execution. So the Signal Report addresses each and every one of these aspects and tries to do it in a programmatic fashion that as you read the report, it builds towards the view of what will happen with valuations with transaction volume. And speaking of the think tank, we leveraged everybody throughout the business to build this view and make it a truly global vision. Now, obviously, we have resolution on each of the regional areas. This is a long way of circling back to your question. So the most important determination is that our view is that as we get towards the end of the year, vaccinations are going to enable economies to reopen substantially. In reference to our reopening tracker, we think that most of the major economies, will be around 90% open as we get to the year end. That in turn is going to enable a return to the office, a return to experiential retail, in combination with support of monetary and fiscal policy, is consistent with a very dramatic reacceleration in growth. And largely we'll see by the end of the year, most major world economies recovered. In Asia Pacific, most economies have already recovered. So the US comes first, then you have developed Europe. That in turn creates the conditions for a reacceleration of the capital markets. Now, the residential and the industrial logistics capital markets have remained robust fairly consistently. That doesn't mean they weren't down last year. I would even attach most of that having to do with a reticence to sell, for example, with logistics product. But the notion is that through this year, those sectors remain hot. It's that improvement in the office market and greater certainty in the recovery of the office market that enables a more fulsome recovery of the capital markets later on. When you're thinking about capital groups, we think that private capital will remain active. We see the more institutionally oriented core funds coming back relatively sooner, but then very quickly, once there's actually a narrowing of the bid-ask spread, you're going to see your private equity funds globally becoming much more active. The REITs are likely to be a laggard simply because even before this, a lot of them outside of industrial were trading at a discount to NAV. So really all you can do there is recycle capital rather than actually grow in earnest. The biggest question mark, I think, and this is particularly a negative for for Asia, which counterbalances so many of the other positives that they're facing, is that global capital or potentially regional capital is still going to be tougher as long as there's travel restrictions. And those are going to take time to come off. Now, there's a big caveat to that, which a lot of global capital have regional presences. So, we saw, German capital or South Korean capital that had, boots on the ground in New York were still able to transact last year, and they'll be able to transact this year. And they certainly are with more attractive hedging costs if we're thinking about the U.S. perspective. So, I think, and, obviously you can read the report and it'll go a lot more detail, but that's an example of how we tried to build our view to make sure that it was internally consistent and built from strong micro foundations.
Thanks, David. I thought that was a terrific report. We were speaking earlier today. I believe that's available on your website for general consumption. So for our listeners, I think it's a terrific piece of research.
Thank you. And what I do is I go to Google and I put Signal Report Cushman whenever I want to find a copy of it. So do what I do.
Well, one of the headwinds that you touched upon in the report was interest rates. And, that seems to be on the tip of everybody's mind right now. Really kind of an explosive combination out there of potential risk, right? Tons of dry powder, tons of pent up demand, a 10-year treasury that's up about 100 basis points since election day. At what point do you start getting nervous and say it's time to keep our powder dry? Is it a 2%, 3%, 4%, 10-year treasury? Do you have a sense of at what point investors should start to get a little bit concerned?
And gosh, at 4% treasury, I'd be very concerned about valuations. But I think that that's highly unlikely. I think that the reflation of treasuries is mainly a reflection of greater confidence in reflation of the economy. Now, there's certainly, depending on how you measure it, a premium that is from inflation uncertainty. I don't think necessarily you're expecting like a large amount of inflation over a 10-year period. You go look at five-year forward inflation rates, it's not, there's certainly expectations aren't unmoored yet. They've simply gone back to quote unquote normal. So it wouldn't be until I saw some sense that inflation expectations had really gotten unmoored. I think, again, that five-year forward is probably something a lot of people are going to be watching. And the reason that matters is because, it'd be very bad to end up in the 70 stagflation scenario, but it'd also be bad if it looked like the Fed was going to have to slam on the brakes. I think it's very unlikely in any of these scenarios, outside of like really runaway inflation that was not addressed at all, where you would end up with things like 4% treasuries again. I think there's simply too much QE. There's too much debt in the economy for the Fed to be able to tolerate interest rates that high. So, it'd be much more likely that you just have continued financial repression, which has plenty of historical precedent. And that's what the 50s was. The US federal government had a ton of debt out of World War II, and the Fed kept interest rates very, very low so that there wouldn't be a debt crisis. So it's very hard for me to imagine a situation where you have that amount of pressure. I suspect that we'll have more stability after this initial reflation. There's definitely some forecasts out there that show us getting back to a 3% 10-year very quickly. I think that that's unlikely. I certainly don't think it's consistent with any likely Federal Reserve rate path. So in terms of like getting back to the pricing here, I think that the reflation of 10-year treasuries has narrowed some of the spreads. The spreads were very, very wide. They were even wide when we had treasuries at 2.5, relative to history. And I think that this diminishment of spread is more than compensated for by the improving macro outlook.
Yeah, when we look at our own data, it seems like most maturing loans this year have handles in the 5 to 6% range. Mm-hmm. So rates would have to go up considerably for them to not be able to refinance at something in the fours, right? With a 2%
Exactly.
treasury or 2.5% treasury. And you seem to do some analysis on that there's a decent amount of spread right now between maturing loans and
exactly. And that's true globally. I think we were looking at prime office, so let alone thinking about anything that's a higher cap rate than prime office. There's a really significant cushion even versus long-term averages. So I'd have to see a very significant further moves in treasuries to be concerned about it from that perspective.
Well, amen to that. I think a lot of our listeners like the idea of treasuries remaining under 3% for the foreseeable future. Let's talk about the global outlook. We don't talk a whole lot about things globally here, but you go into great detail there. You're pretty bullish on the Asia Pacific area, less so on Europe. Give us a sense of why that is.
I mean, a big part of it with the Asia Pacific is it's demographic. Now, obviously, you have some countries in the Asia Pacific region that are slower demographic growth. But then you have places like Indonesia and Malaysia that are growing very, very quickly. You even have more stable population regions like China that still have a tremendous way to go in terms of urbanization, which will drive real estate values. And I think that those tailwinds, even outside of the general superiority of the coronavirus response, undergirds a more positive outlook. So whether you're talking about the growth of the residential sector or of office, where you've already had much more robust returns to office in many of those countries, or if you're talking about logistics, I think another factor there is that many of these markets remain relatively less institutionalized relative to Europe and developed North America. And so, that also is going to lead towards more transaction activity, upgrading of the infrastructure and built quality of the stock, and the consolidation in professional management. So all of these factors are supportive of the Asia Pacific, both in the near term, medium term, long term, as an investment market.
On that market, do you see the supply chain industry, the logistics and the industrial changing at all post-pandemic? There's a lot of talk about, positioning the supply chain differently after the pandemic, right? More distribution of supply chain. Do you see that influencing the region at all?
I mean, I think there was always a trend towards some reshoring, even before the pandemic, and that reified the importance of certain kinds of national security or healthcare related supply chains, and making sure you have more reliance on allied countries, perhaps more redundancy in the supply chain. So I think that leads to somewhat higher inventories in different areas. So that's great if you're a warehouse owner. I think that you could have some more preference for regional supply chains. So if you think in an American context, you'd be looking more at Canada and Mexico. And we certainly can see, in the strategic behavior of China, that they're very concerned with making sure that their supplies of raw materials are not as dependent on countries with which they're having some political frisson. The same goes the other way. And then there's nothing to be gained from denying that. So, I think that, you're going to see, a lot more internal investment in China, which is, is potentially beneficial for their market. It's unclear how that happens net. Whereas a lot more Western-oriented supply chains, might be more favorable towards places like Malaysia, Vietnam, Thailand, et cetera.
This might be a longer-term question, but the industrial segment has been second to none during the pandemic in terms of its low delinquencies, demand, absorption, everything else. Is there a canary in the coal mine that you would say this market at any point, like what might that be, where you would say this market has gotten overheated, right? There's too many people building things on spec. There's too much supply. What should investors be looking for that would be that turning point where you said, yeah, this is the point where we want to stop putting money to work. We're getting concerned that there's just too much out there.
I think it's hard to encapsulate in a single number. I'm most familiar with the U.S. figures, where we've been calling for a couple of years that supply is going to outstrip demand. So demand has tended to surprise to the upside. But, particularly if you're thinking about some of the markets that don't have a lot of new barriers to entry, and that includes a lot of the inland markets where there's a lot of land, that eventually you're going to have some correction there. They're not going to experience elevated rent growth forever because supply can respond. But I don't think that happens all at once. Our projections that vacancies do rise nationally over the next couple of years, but they remain below their long-term averages. Can that happen in places like, the New York Metro and the LA Basin? No, because there's just not enough land. The only way you can get new land is you're seeing some cases where office is getting demolished and they're building industrial. And that just kind of tells you where you're at in terms of market, but there's only so much of that's going to happen. At the same time, what I do find concerning at times is some of the cap rates that I see. It's not because those deals won't work out. It's that they require phenomenal NOI growth to work out. There are markets where there's very little margin of safety in these deals. And everybody knows it. But, it's still, at this point, an attractive investment. I think that what you're seeing a lot of is you're seeing higher cost of capital get priced out, and they're leaving. So a lot of the net sellers for industrial product are private capital, as they should be, since institutions with lower cost capital are picking up the assets and building their allocations. And I think that a lot of those guys are going to be there for the long run. We are certainly have seen shifts in transaction volume out of some of the majors into secondary industrial markets, and a lot of capital being raised for that, as well as making some compromises to older product for either repositioning or because there's overflow demand that's being absorbed. But I think that's a lot more of a tactical play because eventually you can get new modern supply, and that's where the occupiers are going to move.
David, the research that you cover also does a nice deep dive into the different property types, and we talk about them, and we've talked about them for the past year on this podcast, specifically lodging and retail that were hit hard. But post-pandemic, what does that look like, especially for those that suffered during the pandemic, such as retail, and what happens to office, which is still a big question for a lot of people?
So with retail, I think that fortress necessity retail really proved itself out this year. It proved itself truly resilient. Grocery anchored centers, not that volumes have been great by any, but pricing has held up, certainly. Even before this, we had a huge bifurcation between Class A retail and non-Class A. And that gulf has widened to Grand Canyon-like proportions. And I think it still is very uncertain, like what happens with the losers post-pandemic. I think it comes down to, like, for example, if you're looking at a Class C mall, are your previous anchor tenants who are able to prevent substantial renegotiations or repositionings, redevelopments of the property, are they so in hock on their back rent that they'll relinquish the space and enable a more aggressive plan? That's a possibility. Additionally, you have a municipality that might be open to rezoning, given the large level of distress in the market. So I think that, we need to look in situations where those two line up, then that property can be redeveloped. I think in most cases they're actually going to be demolished and rebuilt. I think it's actually pretty tough to take an old mall or an old strip center and actually, adaptive reuse it into something else. Even like logistics. And really what you want to leverage for logistics is the fact that a lot of these places have big parking lots that you can use for lower clear height, on the truck, off the truck type stuff. Same thing if you're looking at like a car dealership. Where you don't have those things, like you could just have these moribund centers that linger on for a while. So I think we're going to have a lot of kind of ghost retail that's going to continue. But, so from an investor perspective, it's going to be really either you're looking for these deep value repositioning plays or you're going for the gold.
So you talk about one of the lines you use in the report is overlooking areas of relative strength. What does that mean in the retail segment?
In the retail segment, I think it really comes down to just that outside of like grocery anchored, sentiment has been so very negative. However challenged the segment is, the capital sentiment is actually worse. So you could potentially find opportunities there. So I think we're certainly going to see experiential retail rebound. I think there's certainly going to be some power centers, some big box stores, and even some Class B malls that could be an attractive value if you can get them.
Turning to hotels, you talked about business and international travel likely to lag, right? I think we're in agreement there, Martha, Joe, and I. We talk about the potential for an explosive rebound in the vacation travel, places like Las Vegas and Hawaii and Orlando and so forth. But talk about the business and international travel. How much will that lag and how painful will that lag be?
Yeah, just to reiterate, I'm not worried at all about leisure travel. I think that the Zoom experience, like we're having right now, one legacy of that is that we're not going to have as much business travel. I feel pretty confident that conferences will come back because I don't know about you, but when I go to a conference, I don't go to a single one of the conference meetings. I have side panels with everybody I work with in my industry. And that, that connection can serve you all year. So I think that comes back. I think it's too fun and it's too actually, frankly, efficient for it to go away. But I think that you're flying from San Francisco to New York to go to one meeting, that kind of thing isn't going to happen as much. Or if you do, it's going to have to be a couple different things, or it's going to be a marquee meeting that you do each year. And that ends up with simply less business travel. On the international side, I mean, a lot of people I know would be more than happy to go travel, to go fly to Paris for a business meeting right now, if France would let them in. So I think it's actually going to be political policy that leads to more of the lag rather than any actual appetite by XYZ business person who's vaccinated at such and such a point.
So on that front, one of your winners in your report was the residential segment. You talked about demand coming back and that being an opportunity for investors that's been hard hit. We're seeing big regional differences. We're seeing huge declines in Long Island City and Manhattan, San Francisco as well. I won't speak about those markets in particular, but are you seeing a difference between A, B, and C, and you expect those recoveries to be different between Class A, Class B, Class C in the residential space?
I mean, it's a little bit of there's kind of a mix. I mean, and you guys would know this better than I, but we've certainly seen more payment stress in the BC segment, and that's just because of the economic profile of the renters. Class A, everybody pays their rent, but naturally all the supply that was coming online was newly built product, which is Class A. So if you have fewer people moving into the urban core and some people moving out, you end up with more of a supply-demand imbalance in that segment. So we've actually seen face and particularly effective rents come down a lot more in those segments. I think that there are a lot of owners who believe that there's going to be a bounce back in the rents, and that's why they've been focused on giving concessions rather than taking a bite out of their face rents, because then the concessions can roll off, and if the market demand is rebounded strongly, then they'll have a much quicker recovery rather than kind of inch up over a period of years. I don't think it'll quite be like that. I think that it's going to take some time for those markets to recover from a RevPAR perspective, or RevPAU, revenue per available unit.
Right.
I think it's important not to think that it has to be a zero-sum market. If you go look at our recommended investment strategies, I both feel very confident that you should be investing, if you're a diversified investor, in high growth markets, which are mostly going to be in the Sun Belt because of population. But I also think that there's a play if you're thinking about urban reflation. That ties back to what is the near-term risk in some of these markets. You have supply-demand imbalance in the New Yorks and San Franciscos and Seattles. But the notion that that's fundamentally temporary, and that over the medium term that there will be a demand recovery, and that to the extent that sentiment is negative there, that represents an opportunity. I mean, I think if you wanted to get like one simple model of investment opportunities, finding a gradient between near term and medium term risk. So if there's a difference between those, you might want to think about buying that.
I mean, right now we know that there's tons of dry powder. Are there parts of the market that just can't get a bid? I would think that there's some out there in the retail hotel segments that are just really neglected.
No malls traded last year, let alone like a Class C mall. Hotel liquidity is being down substantially because I was on a call a while back and someone said, you'd think that in a very uncertain market that there'd be a wide range of opinions about what the appropriate underwriting would be, what the future would hold. And that, in fact, that difference of opinion should enable trades. Usually that's true, but not when there's a difference of opinion but no conviction. You need to have conviction to commit to an investment. And so if you're thinking about things like suburban multi-tenant office or full service luxury hotels, in gateway markets, or closed air centers in lockdown markets in general, like those were things that was very difficult for either buyers or sellers, regardless of what their their kind of central, distribution view was to build conviction. And so the bid pools are very thin. Now, on the contrary, it's very easy for people to get conviction around logistics or fast growing, suburban, well-leased apartment buildings or single tenant, strong credit, Class A office buildings in, call it Austin. Those are things that could get done because people had a lot of certainty around the cash flows. And surprise, surprise, the values moved almost not at all compared to pre-COVID. So that's what actually gets exciting about the market as we get into the back half of the year and into 2022, is that you're still going to have some differences of opinion, but you're going to have a lot more conviction around those views. And I think that combined with the capital that you've referred to a few times, which is truly tremendous, is going to lead to a very liquid market and a much quicker rebound in transaction activity than history would otherwise have suggested.
That leads me to our last question. When you talk about polarizing opinions and conviction, from the number of phone calls that I field and the number of questions we get about our podcast, I would say easily number one right now is about office. And there's certainly an enormous polarization. There are the bulls who believe that the new normal is fallacious and that people will come back to the office and at some point it'll feel a lot like 2019. And then you have the other side of the coin, which is no, this is going to be a real supply problem, or I should say a real demand problem going forward as people work from home. And unlike what you said before, the conviction being lacking in malls and hotels, the people who have these opinions have an enormous amount of conviction, in my opinion. So give us your thoughts on office and where we go from here.
Based on our interviews with investors, occupiers, business innovation district managers, of course, observations about the announcements that are coming through now, we definitely think flexible work is here to stay. But what that probably looks like is that your median office worker works from home to maybe 2 days and 1 morning a week. This isn't a formal finding of a report, but that makes a lot of intuitive sense to me. I think a lot of folks are going to work from home on Mondays and Fridays, or Thursdays and Fridays. Something like that that's attached to the weekend. Or you're going to see even more folks working from home in the morning and coming through staggered throughout the day, or that their attendance in the office is going to be, in short, very heavily levered towards collaborative face-to-face activities. But you're still going to need to have a lot of that because both the social science from before and the surveys that we've done suggest that particularly for younger, less experienced workers, new teams, that this actual face-to-face and ad hoc interaction is very important for culture development, talent development, and ultimately for satisfaction and connection to a role. As a result of this, you're not going to have too many fully remote. I mean, we think there's going to be more of that, certainly. But if that's 5% of the office workforce, and maybe it goes to 10%, that to actually enables people to be fully disconnected from where their headquarters are, where their actual locations are. And even then, it's a question of, are they going to want to work from home, or might they consider working from a flexible space? I mean, I think that we've seen more and more companies engaging co-working firms to get global or national contracts to enable that kind of flexibility. So even there, that's just a movement of where the office demand is. So the most important point is that so if most of your workers are still in the same metropolitan area, most of them are coming into the office at least once, twice, 3 times a week, then can you really reduce your footprint that much? Now, the only way you can do that is if you combine 2 different things. One is you force people to come into the office only on certain days. You have to manage that very aggressively, which I don't know about you, but if my company told me that I wasn't allowed to come on the office on a day that suited me, I would not be happy. And maybe that works in a crappy labor market, but later on, not so much. Similarly, I don't know a single person who likes hoteling. No one's like, oh, I just love going into the office and having to ask the front desk where I get to sit for the day. Again, I mean, I'm not saying that that's not going to happen and happen more, but I don't think that that's going to become so normative that it ends up cannibalizing a ton of the office space in the market. So long story short, you have to manage your office footprint to peak utilization, not average utilization. And I don't see I don't see peak utilization coming down nearly as much as the office antagonistas have been. Now, if I was going to throw them a bone, I do think that there's going to be an even wider gap between quality and non-quality office. So, and what makes an office quality is that it is optimized for collaboration and engagement, both within a firm and across for firms who are in a client or competitor or some kind of industry relationship. So I actually think that things like amenities, walkability, co-location for your industry cluster, where your clients are, where the different services firms that you use, that's going to become more important and a larger driver of value. Your very low cost office that's out of the way and it was built in the 80s and it's just not a very inspiring atmosphere, that's going to have problems. That's going to have more problems. So, and that's part of why one of our recommendations is that if you are looking for something really opportunistic, go get a Bon Jovi building and try and upgrade it.
Yeah, two of the big demands over the last 5 years have been co-working space, right? WeWork and hotels and so forth, huge drivers of demand. And the other being tech firms, right? Amazon, Twitter, Salesforce, Dropbox, et cetera, just taking up whole buildings worth of space. Once we come out of that, do you see that demand still there, or are we anywhere close to the saturation point? Especially, I'm talking about the tech stuff.
There's been a real big gap between tech company statements about how their workers can work remote for however, which seem like just kind of feel-good statements. They're completely costless to them, for one thing. And then the actual dollars that the Googles and Facebooks of the world have put down into new 10-year leases. I tend to trust what people do with their money than what they do with their mouths.
Well, there's no denying that demand has been sustained, right? Microsoft in Atlanta, Amazon, everywhere, right? Facebook recently in Austin. So there's no shortage of headlines, as you mentioned.
Yeah, and I mean, that doesn't mean that they're not going to use a lot of remote work. I mean, a lot of the work that they do is people sitting down doing focus work. And I mean, listen, I'm in Colombia right now. Bucaramanga, Colombia. Now, on the co-working side, I mean, in our view, and you can go back and look at our published reports on this, pre-pandemic, is that we always thought that there was going to be a culling of the herd because the sector had gotten too hot, and there was, in particular, at least one name that had gotten way over its skis. It's very clear that, everybody's going to be doing management agreements after this, and that I think that the private label co-working sector is going to see a lot of the growth. I mean, the reality is that there never really were that much barriers to entry for co-working, regardless of what someone's S1 was trying to build up the idea of. So we still believe that the future is more flexible.
David, your report ends with a lot of investment ideas. To give you the last word on that, give us one or two that you feel are either hidden opportunities or maybe surprises.
At a very high level, I think that investing in markets that combine demographics with skill concentrations, that's the quality play. I think that you're still in a market where you can get a premium if you're willing to take some lease up risk or, new renewals coming up. I mean, some of that's perfectly justified by the rent corrections we're expecting to roll through in places like the office markets. But I think that there's a lack of capital that you could capitalize on and kind of, thinking about core plus or, lower value add returns. I think that, we talked about how there's going to be a lot of disruption in terms of whether it's older office product and lower performing retail space. Repositioning or redeveloping those assets is an opportunity, but it's also going to be very risky. If you execute that poorly, it's going to be rough sledding. But if you have confidence in your plan and select the right sites, I think that could be very, very accretive. I think that niche assets really had a breakout year in 2020, and I mean, I was a believer in them before. I even, produced a whole series of niche assets reports in 2019. I still believe in the demographic drivers of those assets. So whether that's looking at life sciences product, medical office and medical retail, as well as things like, data centers and cold storage. Those things have room to run, and A lot of them have a lot of operating challenges, which are potentially both risk, but also drivers of value for superior operators with good partners and experience.
Thank you, David. To those of our listeners that are interested in this report, reach out to us at podcast@trepp.com. You can send your copy, or as David mentioned, you can go to the Cushman Wakefield website and search for Signal Report. You'll see it there. With that, we'll close this special podcast. Thank you to David Bitner from Cushman Wakefield, and thanks to our producers. We have two, Catherine Connor and Haley Keene today. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com. Visit trepp.com for more info and subscribe to the Trepp Wire podcast with your favorite provider. Thank you for listening and stay well.
All right.